And so, for example, I mean, a big exception is like board members. Okay, board of director
That's
members
right.
typically are not employees. Quite often, they get stock options.
That's right.
So, when the option is granted, is there any income that's taxed at that time?
Not as of right now. They may
Okay.
change this
Okay.
because they're looking for ways to
Raise
increase
revenue.
revenues.
Yeah.
You know.
So we'll see what
But,
happens. For
but-
now, no,
but
not
ri-
when the option is granted.
Right, but you know, there is a value when they're granted.
Yes.
That's transferred. But
Yes.
since it's not readily ascertainable,
Yes.
they don't tax it, and nor does the company get a deduction
Right.
on the grant date.
Right.
But the
Okay.
company has to put a theoretical value on it at the grant date, but they do not deduct it on the grant date.
Okay. So maybe I'll elaborate a little bit about that. So some of these rules were developed a long time ago, before there were even traded options. And so there weren't even models back in those days to value.
Theoretical models,
Yeah,
yeah.
theoretical models. Now there are. And so what has happened is now actually there is a financial disclosure that has to be made on a company's financial statements about these options. And they use values based on these theoretical models that we're talking about. But those have not been given effect yet for income tax reporting. Okay, now related to this also, when you exercise a non-qualified stock option, there are withholding requirements.
Yes.
There's income taxes that need to be withheld. There's a bonus rate. Right now, I think it's 25% federal, and then California, I think they're withholding around 10%. That's a really high withholding for California. So anyway, so these need to be paid, and we also have employment taxes, as you said, for Social Security and Medicare. Let's talk about incentive stock options for a moment. So, again, we said only employees can get these
Right.
incentive stock options. Now, when you exercise these, are any income taxes or employment taxes required to be withheld for an incentive stock
No,
option?
no.
So there is not.
And the company does not get a deduction then either.
Right, right. And maybe we should go back for just a moment. On the non-qualified stock options, when an employee reports ordinary income, which, by the way, usually is just added onto their W-2 for the employee, the employer also gets a tax deduction.
That's right.
Right.
And
So that's another important consideration. All right. So there's no taxable income when that option is exercised. What about this thing called the AMT? And you answer the best you can, and I'll try to help you.
No, the last discussion, I defer that one to you too, because
All right.
Michael, that's your area,
Okay.
and I'm.
Okay, he's not a tax person, folks. We're just sort of helping each other along.
And
here to
that
try to
thing
educate
is
you.
changing too. It seems like they started and they
Well.
change it and they modify it.
Well, anyway, so we have a second tax system here in the United States. And so this is for federal income tax. In California, by the way, also has an alternative minimum tax, and some other states do. So you need to find out if it applies in your state. It's kind of unusual for state. And so anyway, what happens is that you figure your tax on two tracks. There's a regular tax track that most of us are fairly familiar with and sort of understand. Then there's this alternative minimum tax track. And so what you do is you start with regular income, but you make adjustments to it. And so, for example, California taxes are not deductible for alternative minimum tax. The property taxes for your resident are not deductible on that AMT schedule. Then you make some adjustments for things, and the one that's most important for what we're talking about today is for incentive stock options. When you exercise an incentive stock option, let's just say that the rules that apply for qualified options don't apply for incentive stock options for AMT. In other words, when you exercise the option, if it's vested, then you report for alternative minimum tax purposes the income as ordinary income on the AMT schedule. You add it onto the AMT schedule, and then you figure a tax based on that. It's a fairly flat tax, and the tax rate is about 28%. Then you compare that AMT tax with your regular tax. If it's more, then you pay the AMT tax. You make up for it later when you sell the stock, so that additional tax that's attributable to this timing difference becomes a tax credit. When you sell the stock, you've got a lower gain on the AMT schedule from the regular tax schedule. That creates a difference between the two, and you're able to use your minimum tax credit up to that amount. This is really complicated, folks. You need to have somebody go through the numbers for you if you're dealing with it. But that's sort of the basic idea. Okay, again, the holding period, more than 2 years after the grant date, more than 1 year after the date of exercise, then you get to report the gain on the regular tax schedule as long-term capital gain. Okay? Now, if you don't meet that holding period, then you report as ordinary income the lesser of the actual gain or the excess of the fair market value of the stock over the exercise price, the option price, at the time that you exercise the option. So you've got this thing that you've got to go back and figure. But there are a lot of people that have had disqualified dispositions and they've got this ordinary income. Okay. Another thing to be aware of is that the amount of incentive stock options that can be granted to an employee is limited. So the maximum that's exercisable in a year based on, let's say, the option price is $100,000. If you have more than $100,000 of these options that are exercised in a year, exercisable for the first time, then the excess amount is going to be a non-qualified stock option. All right. ESPPs, Employee Stock Purchase Plan shares, I'm not going to go into a lot of detail except for, again, no AMT adjustment when you exercise an Employee Stock Purchase Plan. The discount based, we said there's a 15% discount that's pretty typical for most of these plans. That amount is always going to be ordinary income when you sell the stock based on the grant date. All right. Now, why don't you explain for a few minutes, John, a little bit of this theory about why there is a value for these options when you exercise, or when it's granted.
Okay.
When it's granted.
You see, if you have the right to buy the stock at 20 and you have a maximum of 10 years, there's a chance that that stock 3 years later might be 40.
Mm-hmm.
Okay? And you can buy it at 20 and sell it at 40 if you want. If it goes down, you certainly can't exercise and sell it at a lower price. You never want to pay 20 and sell it at 15. However, the option itself, the right to buy it at 20 throughout this period, even though you have restrictions on it, has a value. Mm-hmm. And mathematicians, and some of which have won the Nobel Prize, mm-hmm. Black-Scholes and mm-hmm. Merton, calculated what the theoretical value is of traded options, mm-hmm. okay? And that were not restricted yes. like the employee stock options.
Yes.
However, certain mathematicians and economists have determined that the same model, and there's another model they call the binomial model, they can be modified to come up with theoretical values of granted options that are granted by the employer to the employee, which mm-hmm. you can't trade, and you have vesting restrictions and pledging restrictions and things like that. So the theoretical value of those options can be calculated when they're granted. And it would be less than if the option were a full exchange-traded option. Mm-hmm. The question is how much less? Yeah. Well, it depends upon how you calculate those restrictions and those differences, mm-hmm. okay? In my view, a reasonably volatile stock, when those options are granted, they're equal to maybe 35% of the value of the underlying stock that you have the right to buy. Mm-hmm. For example, if you have the right to buy 10,000 shares at 20, that value is worth the underlying is worth $200,000.
Mhm.
Okay, so if you have some options that have 10 years life and a reasonably volatile stock and a reasonably high interest rate is incorporated into the model, the theoretical value of those options may be worth $70,000 on the day of grant.
Mhm.
Okay, if the stock moves upward, that theoretical value increases. And when it moves upward, for example, if it goes to 30 from 20, it now has what we call intrinsic value or in the money amount.
Right.
Okay? And so the options still have some of that initial theoretical, what they call fair value,
Mhm.
in addition to the intrinsic value.
Mhm.
Okay, so if you have the right to buy 10,000 shares of stock at 20 and now it goes to 30, well, if you immediately exercised the right that you have after you vested, okay,
Mhm.
and you took the stock and then sold it, you would get a $10 profit subject to ordinary income and withholding and
Mhm.
Social Security, and you'd get $100,000 minus tax, minus other things, whereas the theoretical value of those options is more than $100,000. It's equal to the intrinsic value plus what we call this time value or time premium. Okay?
Yeah.
So, so in light of that, you have to understand that the options have value at the grant date. That value increases if the stock goes down without waiting too long.
Mhm.
Okay, it decreases as the stock stays the same, and it decreases as the stock goes down. Okay, so you have a valuable item there. It's estimated to be a certain amount. Now, there may be some people might say that, well, you're overstating the theoretical value, and companies want to show the lower value if they can, and they find reasons to put theoretical values low.
Okay.
Whereas it depends upon the volatility of the stock, the time remaining, and the expected time remaining, the interest rate, and the dividend. It's a lot of inputs into the
Yeah.
formula, but it's quite valuable, and you
Yeah.
have to, in my view, see it that way.
Mhm.
Okay, even though they're just granted, you have a valuable item, and it's theoretical, and it changes over time.
Okay. So if you're having trouble getting your head around what John is saying, let me put it this way in a nutshell. You can buy an option to purchase a stock, okay, what a call option,
Right.
on the market, okay? And if you bought the option to purchase that stock at today's price, even though people would say, well, there's no value there because you could just go out and buy the stock anyway, but because you have this right for a period of time, let's say 10 years, that gives that option quite a bit of value. And you would pay an option premium that would be considerable for it. And we're saying it might be as much as 35%.
Well, that's what I say is a normal value.
Yeah.
Sometimes it'll be substantially less, sometimes quite a bit more.
Yeah.
Okay.
Okay, John, actually, we're about out of time here. So we're going to have another discussion. We're going to talk about hedging strategies in another program. So folks, hope you can catch that show. John, thank you for being my guest.
Thank you, Michael, and I enjoy it.
Okay.
And I hope it's informative.
Good.
Okay.
And folks, hope you got some valuable information here, and we'll see you next time on Financial Insider Weekly.